Top of the morning to you, and welcome to our newest episode of Capital Markets Quickie from MVP Mind Value Partners. The stock market edged higher last week as the market's historic rally extended to the first week of December. Despite a notable slowdown in hiring that was revealed in the November jobs report, major indexes closed at record highs. The US dollar, however, suffered some major setbacks this past week, and some experts think that 2021 may be another bad year for the US dollar. My name is Endrit Cela, coming at you from Frankfurt, Germany, Europe's financial hub and home to the ECB. Let's take a closer look at what moved the markets this past week. The U.S. economy added 245,000 jobs in the historic month of November, missing estimates by a mile, but the stock market didn't seem to notice. 229,000 new COVID-19 infections were reported on December the 4th, and that is probably due to the Thanksgiving festivities from the previous week. Yet again, the stock market doesn't seem to care too much. The unemployment rate declined to 6.7% from 6.9%, but the participation rate also declined, indicating that more and more people exited the labor force. And again, the stock market didn't budge. Well, we have to look at things from a different perspective. What does this really mean? The downshift in job gains, more COVID infections, and more restrictions nationwide could actually apply pressure to lawmakers to reach an agreement for a new stimulus package before the end of the year. Negotiations in Congress over a fresh round of fiscal aid showed faint signs of progress last week, but an immediate deal is far from assured. Democrats and Republicans still remain divided on the size and targets of this new aid package. So mommy and daddy have agreed to buy Christmas presents for the kids this year, but they are still arguing whether it's going to be the new PlayStation 5 or just a warm jacket for the cold winter. And that is precisely what the stock market is pricing in right now. A big, fat stimulus package under the Christmas tree on the 25th of December. And well, you know what they say, don't spend your money until you really have it. Or at least that's what I say, time in and time out. So the stock market has headed into December with quite a bit of momentum, and that isn't necessarily a bad thing, at least according to statistics. And historically speaking, December has been a positive month for the S&P 500 with an average monthly gain of 1.6%. And the great news is that when the stock market enters December on a positive note, momentum has often been carried through the remainder of the year. Did someone say year-end rally? Well, that may be the case because over the past 75 years, when stocks have started the final month of the year with a year-to-date gain of 10% or more, and that is the case this year, the market posted a positive gain for December in 82% of the time. Furthermore, the market rose by an average of 7.8% over the following year. Interesting. Now let's change it up a little bit. Let's talk about the US dollar. After all, it's been quite a rough year for the dollar. Historically speaking, the US dollar is a safe haven for investors in times of crisis, and this year proved to be quite the opposite. However, the US dollar remains the top funding currency with about half of all cross-border loans and international debt securities denominated in dollars. About 85% of all foreign exchange transactions occur against the dollar, and it accounts for 61% of the official foreign exchange reserves. But for the first time since February 2013, more SWIFT cash transfers were handled in euros than in dollars in November. And last week, the US dollar continued its downward spiral, losing for the third week in a row to the euro. On a year-to-date basis, the euro has gained 8.03% over the US dollar. And as a result of the weaker dollar, we saw precious metals showing signs of life again this past week. Silver, for example, put on some major gains, closing the week with 7.49%. So is this the end of the US dollar? No, absolutely not. But this does serve as a reminder that even when it comes to the currency in your portfolio, it is important to remain diversified. And that, ladies and gentlemen, concludes today's Capital Markets Quickie. To all of you listening from every corner of the globe, I wish you all the best, and stay tuned for our next episode on Sunday, December the 13th.